All right. Welcome, everyone. Give a few minutes here, let everybody get connected. Today, it is April 12th, Wednesday, and we are going to continue part 2. Here, I'll throw up the chat. I see some people talking in there. We're going to continue part 2 of our second mortgage training. So remember yesterday we went over what is a second mortgage. So today we're going to be going over pricing and some of the other details that actually will make it happen. So we'll just give a few minutes until we get everybody connected. There we are. Looks like we're live on LinkedIn. A couple comments there. Hello, Taryn and Robert. Just give another couple minutes. Make sure everybody gets connected. All right. Got Tyler on YouTube as well. So it looks like we are rolled out on the platforms. So let's go ahead and get started officially. All right. Welcome, everyone. My name is Nick Hershey. I'm the president of the Mortgage Calculator. We are a non-delegated lender that specializes in unique non-QM mortgages, just like we're going to be talking about today. So I'm joined today with Jose Gonzalez, our sales manager. Our COO, Kyle, is out today, so we will take this over. Yesterday, we went over all of the details of what is a second mortgage. That was more of the basic training for more of our newer team members, but obviously a good brush up for everybody. And today, Jose is going to go into a presentation on actually how to price this and kind of put it together to actually present it to our clients. So for those of you out there ready to jump on board, remember, we're talking about fixed rate second mortgages. Obviously, we can do HELOCs as well, but that's not particularly the topic today. And remember, these fixed rate second mortgages are applicable for primary, second, and investment properties. So that's why we're talking about them today. Definitely something that we're getting a lot of requests for. I want to make sure you guys all understand how to do it on our team, and anybody out there that's interested can check them out as well. So if you're ready, Jose, we can go ahead and bring up your stuff.
Yes, sir. Good evening or good afternoon, depending where you're located, everybody. Thank you for joining us for, like Nick mentioned, part 2 of our second mortgage / also known as HELOan training, right? We broke it into 2 parts because yesterday it was important that we understand the structure. Yesterday we talked more about guidelines, FICO score requirements. So today I'm going to break it down a little bit more with some actual quotes, right? What are we looking at? What can be the best case scenario? That's what I'm going to be quoting for you here today that we can expect for our borrowers. So just to give a little refresher, um, uh, on the properties and the LTVs that are possible. What can we do here? This is where I ended yesterday's training, but I wanted to begin it here so that you have some context because some of you may not have been on last night's training. So you're looking at all the property types that we're able to do, right? The usual single family, the PUD, which is a single family or a townhome. So it's either going to be a detached or attached. The townhomes are what the attached ones are called. Warrantable condos, meaning condos that conform to Fannie Mae guidelines as far as being, reserve requirements, all that kind of stuff. 2 to 4 unit properties, modular homes, Now, be aware, like I was mentioned last night, declining markets and properties not listed, that have been listed within the past 6 months. No manufactured homes, no condo hotels, no non-warrantable condos, and no mixed use properties. Mixed use here, we're talking about residential mixed use, where it could be maybe an apartment, a condo on the second floor, and a retail space on the first floor, as long as it's 51% residential. Usually not an issue, but it is an issue for the HE loans. All right. And to give a refresher on our income types that are possible here, we're looking at self employed. They could be either salaried, hourly as well. So our full doc, self employed, hourly, salary, 12 or 24-month bank statements can be personal or business or combined. 24-month P&L, 1099, and asset depletion. So, what are the benefits of a HE loan? Now, we talked last night about what a HE loan is not. Like Nick mentioned, a HE loan is not a HELOC. HELOC are open-ended, variable rate, combined to the HE loan. So here, the best way to use the HE loan, we're looking at. We've been told by all of our investors, our secondary market investors, that a lot, in some cases, up to 50% of their business is second mortgages. And why is that? Well, because you have a lot of people out there that if they financed their property or refinanced if it was already a refi within the last 2 years, I would not say within the last 6 to 8 months, but probably before that, they have a very low rate, or should I say much lower, definitely, than what is available right now. And they may not want to touch it with a 10-foot pole, right? They're saying, no way, I got my DSCR is at 3.6%. And I mean, yes, I do want to do something, but I don't want to touch the first loan on the property. Well, there's a good possibility that that property has gained some equity in the last 2 years and they don't want to touch it. That's fine, because that's one of the great benefits here. No need to pay off that low interest rate first to tap into the property's equity, hence why they call it the home equity loan. You can combine this HE loan with a first mortgage if it's a purchase, for example, to avoid mortgage insurance. That's always a concern. You can combine it with a first mortgage for a condo as well. As I mentioned, the closed end second mortgages are lower rates than an open end HELOC because it's less risk for the company making the loan. The fixed rate is definitely better for long term investments for your investors, right? So I mean, obviously, it's, the HELOCs they love when it's like, yeah, I'm just going to get a little bit of money out and then I'm going to fix the property and I'm going to sell it. But what if that's not the case? What if it's like, I'm going to get a lot of money out and I'm going to buy one or two more properties and I don't necessarily have it on the agenda to, resell these properties anytime soon. My intent is this is a property I'm going to hold. I want to, whatever type of rental arrangement they're going to do, but they plan to hold it with a short-term rent, long-term rent. They want to hold the property. So obviously, a fixed rate allows you to plan your cash flow better than the variable rate. And on top of that, it's 2% lower rate, more or less, the spread from a comparable HELOC to a comparable HE loan. And that's assuming that the HELOC is for a primary or second home, not for an investment, and definitely not bank statement, because then you would definitely have no options on the HELOC for the bank statement option. So um, now I mentioned allows investment properties and allows alternative income documentation. So Now you see why there are so many opportunities right now. I mean, we've told, like I mentioned, up to 50% right now of their production of the loans that they're funding is, second mortgage he loans, and you can see why, all the bank statement, all the different options. So now you're probably wondering, okay, Jose, but what is actually possible? You've already let us know you can do it, but what can you do? So here we have full doc borrower 760 credit, and I'm going to jump into a bigger version here so you can actually see my screen a little bit better. But I just want to give you the points here. We're looking at wage earner would need to be 1 year W-2 and pay stub. Believe it or not, some of our options do have a DU option. So they will actually use the Fannie Mae doc option for this full doc option. So really cool there. Self employed, always 2 years tax returns will be required because they need to see all of the action that's going on there. 43% DTI for the best options, even though we can go up to 50%. And don't get stung on this one, but remember, you got to qualify on the full note rate. So let me go on over a minute to the quote, and let's go for our full doc purchase, and let me make it bigger here for you also.
Yeah,
You
zoom
know,
in a little bit.
yeah, I'm zooming in a lot because I had zoomed out to be able to copy it here. All right. So I think now, so here we go. Full doc purchase 90% CLTV. This could be for a purchase or it could be for a refi, either or. Uh, Same rate. Now you're looking here, 9.75 is our lowest rate option, with 10.625 our lowest cost option. And we're looking here at $150,000 second mortgage. So when you're looking at this and considering what's going on here, this is pretty good. This is a second mortgage. Remember, they're in second position. That means that if anything should happen here, they don't get paid until the first mortgage gets paid. So you got to understand why the rates are a little bit higher, and you also got to understand that they're substantially lower than the HELOC. So full doc 760, 90% CLTV. So let me go back now and we go over our next full doc investment. This was full doc primary. So this is full doc investment 760 credit. Again, the difference here is, and I'll show you now in our quote, same parameters regarding the document requirements. The difference here is that you're looking at obviously a little bit higher rates. 12, but again, this is investment property. This is a HE loan. This is 80% CLTV.
This is
12.
unheard of.
Yes, I know. I mean, I keep having to pinch myself, right? This just came out too.
Yeah,
This
this
is
doesn't. This never existed, guys, for
yeah,
forever, right? This never existed before, so this is something brand new. That is very cool.
yeah.
Uh,
We've had this product for about a little bit of almost 2 weeks now that we were given the guidelines and matrices for this, and we're very excited. 12.375 actually gives you a little bit of a lender credit, and then you can buy it down to 11.75. And that, there was, I think, no, there wasn't any additional buy down on that one, and that's actually only like 1 point buy down on that. Very inexpensive. The rate is what it is, right? So if that's not exciting enough, right, then we can go to our bank statement option. Now this one really is amazing. What more can I say? Again, remind you all, we can use personal, business, combined. The best option does require one borrower to be self employed for 2 years. And we also have another option, obviously, as we have these variations, rates could vary a little bit. We have another program option that the borrower only has to be 1 year in business as long as they were previously to that in the same, and this is key, in the same licensed trade previously for at least another year. So if it's a licensed trade, like for example, electrician or anybody else that maybe they were required to have some type of a license when they were maybe working it as an employee for somebody, but they still had their license, their certifications, whatever it is that you need to do that work, and then you can uh, combine the experience, and then as long as they have that 1 full year in the new job, because you are, I mean, in the new business, because you are going to need at least 12 months bank statements, then you would be able to qualify. And we do have another option for this one, which is also allows multiple use of incomes actually. So again, that one's going to be a little bit higher, but that one you can actually combine multiple uses. So let me pop on over to my bank statement primary option right here. And you will all notice, look at the rates on that. And that is basically the same rates and the same LTV that you got on the full doc option. Because those of you that have been pricing out bank statement and full doc non QM loans, you will see that many of the programs have the same rate, right? The bank statement primary and the full doc also primary going to have the same pricing, and you're seeing that right here. So 10.75 has a little bit of a lender credit, $113, and you can buy it down to 9.75 with a little bit, that's about 2 points, just above 2 points there on the cost. So primary bank statement, good, pretty good option, but it does not end there, because we have one more option to share with you, our bank statement investment, right? So this is really the one that blows people's minds, because we can do 80% CLTV on this option. Um, I mean, you're talking 4 unit property, for example, 2 to 4 unit property. I mean, there's a lot of those out there. They don't know that this exists. So, the sooner you all get on the horn and let all your investors know that they can do a second mortgage using bank statements on a 2, 3, and 4 unit property, as well as a 1 unit property, of course, they're going to be excited. So, just hint, right? So this option here, let me pop on over to the full size quote here. So here is our 80% CLTV option on bank statement, and look at that, 12.375% with a $200 line of credit, and 11 point, and you can buy it down all the way down to 11.75%. So if I'm going to switch over to the investment one, I believe that it is the same exact rates for the investment full doc and the investment bank statement. Same exact rate, same exact loan to value. So I mean, we have some magnificent ways here to help people tap into the equity. You may have heard a lot of the investors didn't want, and the homeowners didn't want to do it because of the low rates. Well, now you got a great solution for them, so that they can keep buying those properties and then getting the first mortgage on the property. And believe me, this is gonna be like an additional stream that you're gonna love,
Never-ending stream, recurring stream of revenue. Let's
especially with the
go.
investors.
Let's go over that one more time, Jose. Of what the second mortgage is and why it's more risky. I think we didn't really touch on that last meeting either. So when a property does go bad and has a foreclosure, what happens and why is that very different between the two? Can you just
Yes, I briefly touched on it when I was explaining the rate differentials now. And higher risk or should I say, higher rates are associated with higher risk. It's a directly proportional relationship, right? The higher the risk, the higher the rate. So when you have a financing that occurs, if you are the company that makes the, let's say, initial loan on the property, the first mortgage, you are in first position now, and you have that deed recorded, and everything is in the note and and everything is in the public records that you are in first position. So the reason that they call second mortgages is because it is a mortgage where the mortgage itself is going to accept subordination. That means they will agree to go into a second position behind the currently existing first mortgage. And I mean, that's the only way you could do it, unless the first mortgage were to say, "Oh, I will subordinate to you and you can be first." That's not going to happen. They're first for a reason. So then the second comes in and has to realize that should there be any issues with payment, that foreclosure has to occur, then and the property gets sold, the actually gets foreclosed upon and it gets sold, the first mortgage is going to have first dibs on the money because they are in first position. The second mortgage, if the second mortgage wants to foreclose, the second mortgage also has to foreclose on the first. And then when the property sells, they have to honor the order. And if, for example, it was a $500,000 property and there's $400,000 total owed on it, and the property sells for $300,000, well, the $300,000 is going to get paid to the first mortgage if that's what they were owed, or let's say they were owed 350, and the second was owed 100. Well, the first mortgage is going to get 300, and the second mortgage is going to get zero. And so that is the
and
reason
that's
why.
often the way it shakes out, right? So the
Yes,
second mortgage often gets held holding the bag with zero, right? So, and there can also be third, fourth, fifth, sixth, seventh, eighth, ninth, 10th positions, which are often like mechanic liens, right? Like a contractor or something like that. So there's many positions. First is the only one that really matters because they get their money first. So that's why first, much less risk. All the first mortgages will have X rates. Any second mortgages are going to start at the bottom of where the first is, right? There's no second mortgage is going to be cheaper than a first mortgage. It's just not going to happen. So that's the way it works. We do have one question in here, Jose. Let's bring in one question from Adam real quick. These do not apply to multifamily commercial properties, correct?
correct. Unfortunately, not. 4 units right now is it. I mean, I'm not saying there may not be something out there in the commercial world, but the options we're talking about here do not are not applicable to anything above a 4 unit, nor mixed use, nor anything like that.
Gotcha. All right. And then the one other thing that I want to talk about that you touched on briefly, but when an investor, we're talking about our investors here, which is typically why we're excited about this product, right? Because we've always had HELOCs and second mortgages available for primary homes, but this is new for investment homes, right? So that's what Jose was saying. Just in the last 2 weeks, we've added this where we can do these second mortgages for investment properties. Now, what is the difference when someone gets say a loan from a credit card versus a loan from a HE loan or a HELOC, a second position lien on a property? Can you help me out there?
Absolutely. That is the difference between being able to use secured borrowed funds as a source of funds for a transaction and not being able to use unsecured borrowed funds as a source of funds for a transaction. So, how that translates in plain speak is, if you pull money out of a credit card and you put it into your bank account, um, there's a good possibility that that's not going to be able to use if the option that we're using for your loan requires sourcing and or seasoning of large deposits. Now there is maybe one or two of our business purpose loan options that don't ask us to season large deposits. So, so that keep that in mind. But for all intents and purposes, for what we're looking at right here, for any other type of loan that is a full doc or an income verification type loan, they will be looking at those. And then if you pull money out of a credit card and put it into your bank account to use it for a normal purchase for a source of funds, you're probably going to have to wait 60 days for that money to season, where then you're not going to have to show that deposit anymore because now you're dealing with two totally different bank statements. So, whereas if the money came from a HE loan or also a HELOC, because they are both secured by real estate, those are secured borrowed funds, totally acceptable. We show the HELOC, paperwork to show what is available, and then we show the transfer of the funds going into the checking account and already and leaving the line of credit, and we're good as far as sourcing our funds. No seasoning required.
And it's same as cash, basically, right? So remember, a HELOC or any funds from any loan, cash out loan on any property you own, any cash out, whether it's first position, second position, HELOC, any of those, you can use that cash instantly as cash. That is cash, right? Whereas any other source, if it's cash under your mattress, obviously that has to be sourced in season. If it comes from a credit card, it has to be sourced in season. If it comes from a business line of credit, it has to be sourced in season. If it even comes from your business bank account, it might have to be sourced and seasoned, right? If you're a self-employed person, right? So a lot of advantages to doing a quick loan in order to get some cash out of a property you own in order to purchase unlimited more properties, right? Because it's the same as cash. You can also, as Jose said, get the line of credit or the HELOC or the HE loan and use that as funds on multiple transactions and whatnot. So a lot of flexibility when you add a HELOC or a HE loan as your source of down payment funds. Fully acceptable. Don't have to show any cash in the bank or anything like that because we have the evidence of this HE loan or HELOC as secured cash funds, same as cash. So big difference between same as cash and otherwise. Any other questions here? Looks like a lot of chat. Anybody got any questions before we jump off? I know these second mortgages are confusing. For our team, there is a guide in that we're putting in there for quoting these new products for you. It's pretty easy. You just click second mortgages. But we want to make sure we did this training so everybody understands what a second mortgage is and really how to set that up properly. So hopefully that makes sense for everybody. Don't see any more questions, so let's go ahead and wrap it up. So thanks everybody for joining us. We do these trainings every Tuesday and Wednesday, 7 p.m. Eastern. We also do our every day of the week, Monday through Friday at 11 a.m. We do our live rates, so please check us out again on YouTube. And thanks everybody for joining us, and thanks Jose for going through all the second mortgages.
Thank you, everybody. Have a great night.
Have a good day.